Imagine waking up tomorrow and discovering that the fuel that powers the entire world has started to disappear. Flights being canceled, ships stuck in ports, trucks stopped on highways, gas stations running empty. And within just a few days, the price of energy skyrockets across every continent. It sounds exaggerated, but energy experts warn that a scenario like this could happen much faster than most people imagine. And the most concerning part, some signs of this crisis have already started to appear. It all begins with a simple question. What would happen if oil became too expensive? To understand the size of the problem, we need to remember something essential. Oil is not just fuel. It is one of the foundations of the modern economy. Without it, almost nothing works. Gasoline moves cars. Diesel moves trucks. Jet fuel keeps airplanes in the sky, but the impact goes far beyond transportation. Plastics, fertilizers, chemical products, medicines, synthetic fabrics. A large part of what we use in our daily lives depends, directly or indirectly, on oil. This means that any shock in the price of this commodity can trigger a chain reaction across the global economy. Today, the planet consumes about 100 million barrels of oil every single day. That is an enormous volume. And it means that any significant interruption in supply could trigger a global race for energy. When supply decreases and demand remains high, prices rise a day, and they rise fast. History has already shown this before. In 1973, the world experienced one of the biggest energy crises in history. At that moment, oil-producing countries decided to drastically reduce exports. The impact was immediate. Within just a few months, the price of a barrel of oil quadrupled. Gas stations ran empty. Long lines formed in several countries. Some cities even began rationing fuel. And many economies fell into recession. But there is an important detail. Today, the world is even more dependent on energy than it was back then. Global transportation has grown. International trade has expanded. Industrial production has spread across almost every continent. Supply chains have become more complex, and all of this depends on one essential thing: cheap energy. Now imagine what happens when the price of oil begins to surge. The first impact appears in transportation. Trucks that carry food become more expensive to operate. Ships that cross oceans increase shipping costs. Airlines raise ticket prices. And very quickly, the rise in fuel prices begins to spread across the entire economy. Because expensive transportation means one thing: more expensive products, more expensive food, more expensive electronics, more expensive clothing. Everything starts going up. This phenomenon has a name that economists know very well: energy inflation. When the price of energy rises, it pulls almost every other price up with it. And that creates a major problem for governments and central banks. Because when inflation skyrockets, there is a traditional response: raise interest rates. But higher interest rates make borrowing more expensive. Companies begin to invest less. Consumers begin to spend less, and the economy starts to slow down. In other words, rising oil prices can create an extremely dangerous combination: high inflation and low economic growth. This scenario even has a specific name: stagflation. One of the most difficult economic environments to control, because there are almost no simple solutions. If governments try to stimulate the economy, inflation gets worse. If they try to control inflation, economic growth slows down even further. But the energy crisis does not stop there. There is a second effect that can be even more devastating: the impact on supply chains. Today, a large portion of the products we consume travel thousands of kilometers before reaching us. A smartphone may have components manufactured in several different countries. A car may have parts coming from multiple continents. Food can travel from one hemisphere to another. All of this depends on cheap transportation. When oil prices surge, the cost of these logistics chains explodes. companies begin reducing production. Some factories simply stop operating, and shortages begin to appear. This is exactly what partially happened during the pandemic. Congested ports, containers stuck in terminals, reduced transportation. Imagine something similar happening on a global scale, but caused by an energy crisis. Products disappearing from store shelves, delivery times becoming longer and longer, companies struggling to keep production running. And when situations like this begin, another powerful factor enters the equation. The psychological factor. Consumers begin stockpiling goods. Companies begin protecting their inventories. Financial markets go on alert. Investors begin pulling money out of assets considered risky, and confidence in the economy starts to fall. The result can become an explosive combination: inflation, shortages, financial volatility, and economic slowdown. But there is an even more critical detail in this equation. Oil production is concentrated in a few very specific regions of the planet, and many of them are geopolitically unstable. A large portion of the world's energy flows through strategic routes in the middle. East narrow maritime passages where massive volumes of oil pass every single day. If any of these routes were interrupted, even for just a few days, the impact on global markets could be immediate. Prices would surge, markets would react, and entire economies could begin to feel the consequences. But if expensive oil is already capable of slowing down economies, there is an even more concerning question. What happens when the price of energy not only slows countries down, but begins to break entire economies? Because in some cases, an oil crisis does not only cause inflation, it can trigger full economic collapses. And that is exactly what we are about to understand now. When oil prices surge, the impact is not the same for every country. Some economies can absorb the shock for a while. Others begin to feel the effects almost immediately, and in more extreme cases, they collapse. This happens for a simple reason. Many countries depend almost entirely on imported energy. They do not produce enough oil, so they need to buy fuel on the international market every single day. And when the price of a barrel suddenly rises, these economies face an immediate problem. The cost of imports explodes. Imagine a country that needs to import millions of barrels of oil every day. If the price of a barrel rises from $70 to $140, energy spending simply doubles. That means billions of extra dollars leaving the economy. Money that could have been used for infrastructure, for social programs, for investments, but now must be spent just to keep the economy running. In economics, this phenomenon has a name: a terms of trade shock. It happens when a country suddenly needs to spend much more money to buy an essential resource. And when that happens, the trade balance begins to deteriorate. More money leaves the country, less money comes in. The local currency begins to weaken, and the risk of a financial crisis increases. But there is a detail that makes this problem even more dangerous. Oil is traded globally in dollars. This means that if a country's currency loses value at the same time that oil prices rise, the impact on energy costs can become devastating. The country ends up paying more twice. First, because oil itself is more expensive, and second, because its own currency is worth less. This kind of situation has happened many times throughout history. During energy crises, several emerging economies faced deep recessions. Some even declared debt defaults. Others saw inflation spiral completely out of control. But the impact does not remain limited to the energy sector. When energy becomes too expensive, the entire economy begins to suffer. Factories start operating with much higher costs. Companies reduce production. Some simply shut down. Unemployment begins to rise. Consumption begins to fall. And quickly this cycle can turn into a recession. In extreme situations, into a full economic depression. There is also a powerful effect on the food sector. Much of modern agriculture depends directly on oil. Tractors run on diesel. Fertilizers are produced from energy-based chemical inputs, and transporting food requires fuel. When oil prices rise dramatically, food prices usually rise as well, and that creates enormous social pressure, especially in countries where a large portion of household income is spent just on food at different moments in history. Energy crises have triggered massive protests, political instability, and even changes of government. Faced with this situation, governments encounter a difficult choice. Either they allow prices to rise or they subsidize fuel. But subsidies can cost billions of dollars, and very few countries can sustain that kind of spending for long. When governments try to artificially keep energy prices low, public deficits begin to grow. Investors start questioning the country's fiscal stability, and when confidence disappears, the cost of debt skyrockets. Governments must pay higher and higher interest rates to finance themselves. This can lead to a fiscal crisis and, in extreme situations, even to a currency collapse. At the same time, financial markets tend to react quickly to energy shocks. When oil prices surge, investors look for assets considered safer. Money starts flowing out of emerging markets. Stock markets fall, currencies lose value, and access to international financing becomes more difficult. In other words, an energy crisis can trigger an extremely dangerous sequence of events. First comes rising inflation, then economic slowdown. Next come fiscal pressures, and finally the risk of a financial crisis emerges, all triggered by a single factor: energy that has become too expensive. That is why many analysts describe oil as the invisible gear of the global economy. As long as it remains relatively stable, the economic system continues functioning. But when that gear begins to fail, the impact can cross continents, affect governments, and completely alter the balance of the global economy. This is exactly why every conflict in the Middle East, every international sanction, and every disruption in strategic oil routes is watched so closely by global markets, because, in the modern world, energy remains one of the most critical pillars of the global economy, and when that pillar begins to shake, the impact can be felt in almost every country on the planet.